more on this latest inflation read. We're joined by Yelena Maleyev, who is the KPMG senior economist, and Jeffrey Kleintop, Charles Schwab chief global investment strategist. Great to have you both here with us this morning. Yelena, I want to start with you. You take a look at and hear of these figures. What does this set up, not just for the Fed calculus, which of course many of the investors are going to kind of pair this with, but ultimately what the pathway of inflation looks like?
I would say that overall, this is a very good report in that the core figure is continuing to decelerate. We know that food and energy prices tend to be volatile any given month, and we did see a jump in energy prices in September and then a cooling in October. So we will see that in next month's report. But overall, shelter inflation is still very high. It has been coming down. In the real world, in the market rents, we have seen them start to decelerate since last year. So that will eventually show up in the CPI data simply because of how lagged the data is. But overall, I would say this is heading in the right direction. We know there's volatility ahead, but I would say this is an overall good report.
Jeffrey, what do you think? Do you agree?
No, I can't agree with this. I think the market was braced for a hotter report after a hotter PPI yesterday and a hot jobs report on Friday. So the initial reaction to this number may be muted, but inflation's proving to be stubborn, and that's likely to weigh on markets in Q4. CPI coming in at 3.7% is the third straight month without a decline. And that may shake confidence that inflation is steadily continuing to recede. And more importantly, core inflation in the 0.3% range for the past 2 months annualizes at a pace well above the Fed's 2% target. The PMI price component, that's the Purchasing Managers Index pricing assessment, continues to point to a stubborn outlook for CPI, lingering in this 3 to 4% range above the Fed's target over the coming 6 months. So the market's confidence that we may see rate cuts next year or even an end to QT, I think is really proving to be misguided here.
Jeff, just to stay with that thought for a hot second here. So if you think about what the Fed has to digest, and we just got their meeting minutes yesterday from the most previous meeting, how does this change the discussion going into that November meeting?
Well, not only is inflation proving to be relatively stubborn here, we've got some upside risks. We know the Israel-Hamas conflict will likely be a topic of discussion at that meeting. That holds upside inflation risks, as does the weather-related supply chain backups we are seeing around the world related to the El Nino. We've got a real backup here in the Panama Canal. We've now got ships being restricted as they go through not only how loaded those ships can be, but the number of ships coming through that canal. That's creating potential supply chain problems. Maybe these issues are transitory, maybe not. What I can tell you is the Fed is going to be focused, if not continuing to hike rates, they're going to be focused on continuing QT, quantitative tightening. That unwinding of quantitative easing is going to be a major focus of discussion. And as that continues, financial conditions are going to continue to tighten in the US and around the world. And we know historically, those have not been good conditions for the stock market.
And Yelena, going off of what Jeffrey was just saying there, just in terms of how the Fed is going to be thinking about this report, what this means for policy here going forward, how do you see the Fed walking that balance here, trying to balance the fact, the risk of over tightening versus not doing enough? Because yes, in some aspects, we are making some headway on inflation, but still in this report, many items here proving that inflation remains extremely sticky.
This is true. Inflation does remain sticky. The fact that it's been decelerating, I think, is the most important part of the focus of the Fed. But we do not expect the Fed to cut anytime soon. We don't expect them to hike either, because we've seen that the long bonds, the bond market has been doing a lot of the tightening for the Fed over the last few months. And so the expectation that conditions will remain tight, especially in the credit market, will help cool demand and cool some of that spending into the end of the year, especially as student loan payments get resumed, especially as folks have been pivoting from spending on stuff, instead spending on services like travel and dining out. And so we do expect to see this cooling down, especially when I mentioned the shelter index, the rents coming down in many parts of the country as more apartments get built. And so there is an expectation that the Fed is going to hold and wait. And in the world where we have higher growth prospects with GDP being revised up, we do expect that in a world with higher growth prospects, it's also a world of higher rates.
Yelena, following up on what you just said, when you talked about the surge that we've seen in bond yields, I think a big question here is how much pressure that is going to put on the economy. What are your expectations there?
It will definitely continue to put pressure on the housing market. We have seen the mortgage rate flirt with that 8% figure. That's incredibly huge compared to what you saw last year. And so these tightening of credit conditions, these higher bond rates are going to cool demand in the very interest rate sensitive sectors like housing. Now, many folks are locked into fixed rate mortgages and have pretty good credit standing. And so it's not going to affect everybody, but we've already started to see a lot of that cooling coming in the housing market in terms of demand for mortgages at this time.
Jeff, as we think out to next year and the likelihood of a cut, what would the Fed need to see? Would the Fed need to continue to enact policy until they get towards 2%, or do you believe that they can sit at 3% and perhaps start to feel like, okay, the job's been accomplished, even if they didn't get all the way down to flat 2%? Maybe it's a two handle that we're looking at.
I think that probably is going to be a discussion within the Fed, but I think they've lost enough credibility that before they say 3% is good enough, they need to get a little closer to 2%. And I think that's going to prove to be very hard to do. And the market, I guess it's just convinced that they're going to cut no matter what. And I'm often reminded of the Mark Twain quote, it ain't the thing that you don't know that gets you in trouble. It's the thing you know for sure that just ain't so. The market is sure the Fed is going to be cutting rates next year. They are done, 90% confidence priced into the futures market they'll be cutting rates next year. While I believe it's possible, I don't share that same degree of confidence. And if the market reassesses that stance in light of more data like today's CPI report, it can move the market sharply, since everyone seems to be on the same side of the boat.
Jeffrey, taking a look at the bond market's reaction to this, we are seeing some upside here on the 2-year Treasury yields. Not too much movement on the 10-year, but if in fact this points to the fact that maybe the Fed is not done, or maybe the fact that we could see a little bit more of a move to the upside here in yields, I guess how much more of a move to the upside are you potentially seeing in the 10-year?
It's so hard to say. Already we've seen such an incredible move that it's difficult to say how much more we get from here. What's probably more important is that rates may remain relatively high from here. We just talked a little bit about the negative implications that can have for the economy. Already we're feeling that at the smaller business level. And I think as we go through the earnings season here, you're going to hear this from a number of businesses as well. It's become more costly to implement those capital expenditures and hiring. I think the job market could begin to soften up later this year as we see more services industries reflecting this very tight credit environment, not tight credit environment, but more costly credit environment. It's often not, it's not the demand picture that's a problem at the moment. It's more that the cost of investing in these things is becoming more of a challenge for these businesses. I think that'll be a theme running through the earnings season.
And then just lastly here, Yelena, a final word to you. When you think about now going into the holiday season, for any consumer that is out paying close attention perhaps at 8:30 a.m. as we are to this CPI print, and has a few more of these prints prior to the depth of the holiday season, is there any kind of fatigue that consumers are starting to show with regard to recession discussion, recession fears, concerns?
Definitely, because remember, as we're paying attention to inflation, which is the change in prices, consumers are facing the actual level of prices, which are still high compared to a year ago and rising. So there's definitely fatigue from the high price levels, the need to want to see friends and family over the holidays. Costs are still high for those things. And so there is definitely a concern in terms of the consumer's perspective of how much longer do we have to face these high prices. But in May of this year, we started to see average hourly earnings actually start outpacing inflation. So folks are getting some of that real purchasing power back, albeit slowly. And so there is still a lot of income out there growth and a lot of job growth as well. So folks are, feeling confident in that regard. But in terms of spending, there's definitely going to be a cooling, especially the student loan payments come back online.
Yelena, what's your base case on whether or not we'll see a recession?
Right now, we're putting it at about 25% for the next 12 months.
All right, Yelena Maleyev of KPMG senior economist, and Jeffrey Kleintop, Charles Schwab, chief global investment strategist. Thanks to you both for helping us break down the CPI print.